Hello, Warriors. How's everyone doing? Hiya, Brock. Anyone remember the Allman Brothers album? Eat a Peach Mint? Hi, Scott. You remember the Allman Brothers? Eat a Peach Mint? That's what's happening today. Also, get your masks out. Everything starts in China. So talking about China, I don't know if this has anything to do with the virus they're trying to control. A lot of viruses. First they take out the pigs and then they take out the people. Throw over back inside US dollar yuan. Okay. That's not positive. So a lot of people were looking for the S&Ps to gap up to new highs before it did this. Right? So high of the move still is 33.2980. And I know a lot of people, I saw some numbers around 33, 34 or so. Could it generate one more shot up? Of course. Anything can happen. So far, maybe ABC, and then we go. We start breaking here. I think 3260 is a pretty obvious area right here. 3260, but maybe we get a 32 test. Ben, if you're here, that's Ben's line in the sand around 3,200. Ben Maldonado. So this is the line for the continuation of the bull market. A lot of space between here and there. And then yen, we still could have a 3, but if you look at the yen right here, kind of looks like a pretty good cliff. And of course, Blake was talking about this yesterday, waiting for confirmation under 109.70. So this is what happened last night. So I do think that we will get that false breakout. And there's a big canyon underneath for Wile E. Coyote if we have a false breakout here. I don't see why. I mean, we will stop at 109, but I think a false breakout will lead to eventually taking this low out. And we'll see yields are starting off a little soft with S&P's lower, NASDAQ down about 35. Here is the 30-year, it's been hanging on by a thread on this uptrend. So it's a little more active. We haven't had overnight trade in the 10-year note, but its uptrend line is coming in still right around 174. So this would tie in with what Greg showed us last week, one more decline in the 10-year note. A lot of people don't think we'll take out this low. I see no reason why we can't if we break down. And, I still, if I'm going to be right about the yen, or, Blake is right about the yen, whoever, if the yen fails, let's not personalize it. I think gold still has a chance. It's holding where it had to so far, right here. So, you could buy it here and risk $10, because if we get back above this 1570 level, we could try 1580, maybe 1590. But turnaround Tuesday, perhaps the turn is buying the dip in gold, selling the rally in yen, and dare I say it, the possible top in the S&Ps for a correction. Looking at oil. Also, maybe the dollar's turning too. I don't like that the pound is stronger than the euro, but Blake said yesterday they'll take out the these lows, and then he was looking to buy like a stop hunt Don't know if he got it off, did it? We'll find out in a few minutes, but we're getting a nice little reversal day here. So we'll see. To me, closing back above 1120 or so would be positive. So look how it held the 200-day close underneath it, heading up. I don't have anything on in the dollar. Got out of short dollar positions, long euro this day, didn't short it, not long it. I don't know. It's an I don't know for me. I seem to have more conviction about what could happen in the end based upon what could happen to yields and what could happen to S&Ps. So I'll leave the euro and cable and Aussie to, you know, the pros here at ForexAnalytix. And one note, SPY had a 12% correction in November with the SARS breakout. Huh. Okay. Yeah. Everyone's got the flu, birds, pigs. Yeah. So thank you for that, guys. And hey, Ben. So I think I was going to talk about oil for a minute. Short-lived pop, back underneath the channel line. That sure was a feeble rally. I thought we'd get a lot more than 60. I thought at least back to here, previous support. At new lows here, I don't think we're going to confirm. So I can't short the crude in the hole here. So I'll just let it go. Okay, so Blake, how are you this morning? And right before I bring Blake on.
Hey, good morning, Dale.
Running out of time, guys. When's this end? The 24th? Oh, you got 3 days left to take advantage of this.
Just a couple of days.
Okay.
How's it going?
Good, bro. What's new?
I actually have something kind of interesting. We'll obviously talk about the majors and everything else, and you were talking about the yen. So I'll pull up the yen here. I actually just shorted the dollar yen this morning.
Okay.
I shorted it. I got hit on. Last night we were down here because of the SARS outbreak. Oh, did I say SARS outbreak? I meant coronavirus. Anyway, we were broken down, and I was like, okay, if we get a rally back to previous support, I'm going to go ahead and sell it. So I got triggered on an order just above where we're currently at. But I want to pull up something that's rather interesting that was pointed out by a coworker of mine last night. This is after the dollar yen had fallen, and I was with my family, and I was reading this text, and he was like, during the SARS outbreak, the dollar yen dropped 5 handles, and I'm like, huh. So I'm like, I'm going to look at that as soon as I get up in the morning, because I didn't have an opportunity to do it last night. But if you look at the timeline for SARS, that infected 800 people. We're approximately at 200 with this coronavirus. Now, I'm not a pandemic or epidemic specialist by any stretch of the means, but what I would like to do, and if for those of you like myself that was trading the FX market during that time, we have to kind of take a look at what happened at that moment. So if you look at like November of 2002, when SARS first reared its ugly head, you could go over to the dollar yen, and you can go to 2002 and go to the end of 2002. Oops, let me zoom in here. So November 2002, we were right roughly about here when the epidemic broke out. Very similar. Oops. That's good because I'm short the US dollar, Swedish krona. We won't go into that right now. But you can see we were about right here. Very similar price action to what we're dealing with now. Because if you think about it, I want you to think about where we're currently at. You had this, dollar yen that looked like it was going to break out, right? just think about what we're doing currently. All right. Here's back then, right?
Yeah.
We had this weekly triangle. Let me pull up a different dollar yen chart. Here's dollar yen currently. Here's dollar yen currently, right?
Triangle. Yeah.
Let me delete all this stuff. So here's dollar yen currently, big weekly triangle, right? And a lot of people had actually a lot of people, if you think about what current, and I've talked a lot about this last week, so many people were like, oh no, we're broken out. They were looking at this, right? They're like, oh yeah, this is a breakout. It's already happening. Everybody's bullish. And I've been arguing, well, I'd like to see it get above 110.30 in order for it to be really breaking out. So that was back then. Now, or today. Now let's go to dollar yen back then. Let's go back to the weekly chart. I'll zoom all the way back to 2002. Okay. So kind of similar situation. We were, thinking, oh, here we go for a, big breakout on a weekly chart. Everybody's thinking, oh, we're broken out. And then the SARS epidemic hits, and the dollar yen during that period of time you can go from 125 to let's just call it the January of 03. It picks up some steam, and it goes all the way to 04, but eventually, the dollar yen really, sold off. But you can see the impact that the dollar yen felt. And you might go, well, Blake, you're only talking about 500 pips. I mean, from 125 to 120, really, after the epidemic hit, it's just a 500 pip move. Well, let's go back to today. A 500 pip move takes us from 110 to 105 real quick. And that's a big move in today's environment. We haven't seen a lot of volatility as of late. And so I think for us to underestimate what the impact in the FX market could be in this environment, based on a very low volatility environment, especially with everybody positioned short yen. If you go back to this weekend and you just like Forex Live always post some pretty good stuff as far as positioning for CFTC. Hold on really quick. I'm going to I just took my US dollar Swedish krona off. So just letting you guys know. Just taking some books.
Hey, Blake, if you just measure it arithmetically from the spike low at 107.60 to 110.20, it's 260 pips, and you subtract it from the 107.60 low. If we take it out, it brings it right to your bottom of the triangle.
Hold on really quick. I'm sorry. I'm just writing down something.
Just a subtraction.
Okay. Sorry, I was just writing down in my journal. I just booked some profits in the
good disciplined journal keeper
in the US dollar Swedish krona. Sorry, I was short from yesterday. I was short from 52. Hold on, let me just tell everybody in our chat room right here. Just oops, bear with me, guys.
Another reason
for those
take
people
the
not
subscription.
listening in.
Yeah.
Where was I short? 52. Okay. Oh, Amir says, we know we heard it. No, not necessarily. Not everybody's listening. You might be listening, Amir, not everybody else. That was just a chat that that's our members chat. But anyway, going back to the US dollar Japanese yen, a 500 pip move, and I'm sorry, you were doing some equations there, Dale. And
just simple thing. I mean, the recent high 1020, that spike low at 760 equals 260 pips. You subtract it from the 760 low, and it gets you to your number you were talking about.
Yeah, what, the
105-ish.
105?
Yeah.
Yeah, I mean that's not. I don't think that is uncalled for in this environment. And again, a 500 pip move based on what we've seen recently is a big flipping move. And I'm saying that because we have been in a period of the lowest FX volatility that we've seen ever in the history of, the markets looking at FX volatility. In my career, which is over 20 years of, trading, and I've been trading the FX market 19 years. Since 2001 is when I bridged the gap from equities to currencies. We haven't been in this low volatility environment ever, as far as I'm concerned. And for us to get a 500 pip move would be diabolical for the market. Great if you're on the wrong, if you're at the right side, wrong, and if you're on the wrong side, hell, you're going to be feeling some heat, because when we're in a low volatility environment, what tends to happen, Dale, with most people, and this is traders, institutions alike, what happens when you're in a low volatility environment? Do you think position sizes get bigger or smaller?
He's actually stepped off for a few minutes, but I can answer that. I think Dale has stepped off for a bit. So
hey, I didn't know he stepped out. So what do you think, Stelios? Do position sizes get bigger or smaller in a low volatility environment?
This reminds me when I was trading interest rates, and US rates went from 6% or 5.5%, whatever, to 0, and you had nothing to play with. So you had to make your sizes 5-10 times bigger.
Right. So yeah, you're exactly right. You have to, if you're an institutional guy and you're like, well, shit, well, excuse my language, crap, if I'm going to grind out, 30 pips in the dollar yen, and I need to make some money, I got to step up my position size, because we're in such a low volatility environment. We're not going to get any type of moves, of substantial moves. So I'm just going to go ahead and step up my position size. So now you got everybody positioned: A, short yen; B, a lot of it; and see what happens if it reverses. I mean, if it reverses, then it could be a pretty ugly move if things get carried away. So, and thank you, Stelios, for your comment. So if we go back to yesterday's comments about the dollar yen, I told you yesterday, I wasn't shorting the dollar yen yet, because, if minus today's candle, I was just mentioning yesterday, we're up against resistance. Everybody's bullish. I'm going to turn really bearish if we drop back below 109.70. That idea hasn't changed, because I had mentioned that most people were bullish because we broke through this this non-dotted blue trend line, but the blue dotted trend line is the one that I was really more concerned with, the longer term trend line. And I said, well, if we drop back below 109.70, it's probably going to be pretty bearish. Well, today, we've sold off a little bit. We went as low as 109.88. We've bounced back up. Some comments from Donald Trump in Davos, it picked up the dollar yen back above 110. All the positive comments about, China and, China, what I'm trying to say, the Chinese relationship between the U.S. and China is better than ever. Dollar yen popped up. But if this coronavirus starts to pick up any steam, and we start to see some more cases being reported, because there is an emergency meeting going on, and we start in the coming days start to see those numbers increase, you're going to see that this dollar yen start to weigh down. My opinion is, if we drop back below 109.70, it is going to start to trade very heavy. I am already starting a US dollar Japanese yen short. I know where I'm wrong. And that's, as a trader, when we're, getting into positions, whether you're long or short, whatever asset class you're trading, the most important thing for us to do is to be able to identify where the risk is. I know where the risk is. If I'm short the dollar yen, I know the risk. Basically, we get above 110.35 roughly, it's going to go higher. I mean, it is. And you know, there's going to be a lot of momentum. But what's my risk reward here? If I'm risking, you know, let me just draw it out for you. If I'm risking from where we're currently at, let's just call this 1. If I'm risking 1, what's my reward? Well, let's say there's a move back down to 108. You know, so what am I risking? 1 to make 5. Let's say things get a little out of hand over the coming months or coming weeks, and my target maybe is 106. I hate targeting off, you know, making money off of other people's, you know, situations, but that's the markets. It's what we do. You know, it's we trade based on probabilities, and technically right now it makes sense to be short the dollar yen to make a 5-to-1, an 8-to-1, a 10-to-1 profit. So for me, I'm willing to take that shot right now. I know where I'm wrong, and that's it. And it's not just, you know, the coronavirus. We can attribute, you know, wanting to be short risk for all sorts of reasons. The predominant reason, I think, not so much what's happening with the coronavirus, but the overbought, you know, scenario that we're seeing in the S&P. And you guys know that the S&P is, you know, obviously up against really key confluence resistance. I've talked a lot about it over the last couple of weeks. 161% extension of the 2018 move lower, the 161% extension of the Iranian conflict. And that, you know, that is basically just where we're at right now. As you guys know, I'm actually short just a little bit of S&P. I haven't added, and I'm not going to add unless we get below this blue trend line right here. That's when I'll be confident that the market's actually going to take a much bigger pullback. But this is me basically establishing a foothold in a counter trend move regarding risk assets, and I'm doing it via the dollar yen, and I'm doing it via the S&P. And right now I'm currently a little underwater in the S&P on a very, very small position, but I'm looking to add, and I'm also, you know, short a little dollar yen and basically break even, but I'm looking to add to that too. But I'm seeing the risks. I see the risk versus reward. I think the risk or the reward far outweighs the risk. Hey guys, can you hold on 1 second, please? Stella, do you mind talking for a moment?
Blah, 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 blah. Yeah, I don't mind. Okay. So let me fill in on a few things. Okay. So Blake talked about the coronavirus thing, which I think is the main event of today. I mean, this is, it has the potential of moving markets. People are, you know, at the moment this seems to be contained, but obviously you never know with these things. I want to mention we had we had the DOJ interest rate decision today. No change, no news, no nothing. Contrary to that, we had some UK data, which was good. So we had average earnings index, which everybody looks at, and we've said this before. We compare this to inflation to see what if there's a pinch on the consumer, or if there's a nice amount of slack. And average earnings are at 3.2% year on year. Compare that to inflation, which is around 1.5%. So that's pretty healthy. Unemployment also decreased. So these are you know, good numbers for the UK. And coming into the official Brexit date, this is definitely a breath of fresh air that the UK needs, and sterling also.
I mean, the pound is just ripping today.
Yeah, I mean, overall they were good numbers, you know, and we've heard this story for years now. My God, it's going to be a nightmare when the UK leaves the EU, and it's going to be. People were talking about this on Twitter today. There were, you know, stories about a recession of 1% and, you know, 1 million jobs lost, or whatever number everybody wanted to put. And granted, it's not going to be an easy transition, but I don't think it's going to be a disaster. These numbers kind of show that we're slowly going to get over it, you know, whatever it entails.
Well, you know, I look at the cable, and it's obviously it's doing pretty well today. I'm, you know, to be convinced that the pound is really moving higher, in my opinion, we've got to really breach like the it's really got to breach like the 131. I got a little alarm set here, and I'll actually adjust it down a little bit. 131.20. We break that spike high, and I think that that we have a nice little triangle breaking higher. It's been hard for me to commit being really long the cable. I've been buying the dips, and if you use ForexAnalytix, you can see in our patterns in play, I'm still bullish. I still have, based on triangle, the triangle, and, buying it off of the support here, I'm bullish the cable, but it hasn't been an easy trade. And it's like, you dip towards this triangle support, which we've done on multiple occasions over the last 2 weeks, and just buying it off of this triangle support is where I've made, my money, in the cable. Unfortunately, I didn't buy it over the last couple of days for this rally. I kind of wussed out on that. That's
Blake, I think if this happens, or when this happens, it's going to be in 10 days when we have the Bank of England meeting, and we're pricing more than 50% chance of cut. And today's numbers are a little nudge towards maybe not cutting. I mean, you never know what they're going to do, but it's 50-50, so it's going to move either way.
Yeah, so the jobs numbers did come in really strong. Hey, Stelios, I'm sorry, my office was asking me a question a little bit ago. That's why I had to step away mute my mic and talk to my office really quick. But I am going to pass it over to you guys, and I know Steve's going to be here in just a second. But what I want to say is what Dale was talking about earlier, guys. We have 1 year. Or every year, or actually I say twice a year, because we do offer a special pricing for a few days in September of every year. It's at the beginning of our trading season, because most people have been off for the summer. So as everybody's coming home from their holidays, September, we usually offer a special pricing. But always at the beginning of the year, and this is it. And it'll be expiring the end of this week, and then you're going to have to wait till September if you want these prices again. So if you want to be part of the ForexAnalytix community, you want to know what I'm thinking, or Stelios or Steve. Stelios is in there all day, Amanda's in there all day, Paul Franco is, Joe is in there. I mean, our team's in there. If you want to know what we're thinking all day, this is the time to be involved with ForexAnalytix. Take advantage of the pricing that we have, because you have to be a premium member to have access to our ForexAnalytix chat rooms, because I spend my day there, and I spend more time there than I do with my family. So, anyway, I'm going to pass it over to you guys. Steve, are you here this morning?
Yeah, one family you make money with, Blake, and the other family you spend money with.
This is definitely true.
So you need to have a couple of families to keep things balanced.
Definitely true.
All right.
Well, you guys have a great session, and have a great interview with Mark Newton today. For those of you who don't know, Mark, probably one of the better technicians I've ever seen in the markets, and he's going to be, when you see him on Bloomberg or CNBC, you get him for about 2-3 minutes at a time. Dale's going to have him for half an hour, so you guys want to stick around for today's interview with Dale. Dale always does obviously a great job, but more importantly, he gets to keep his guests for good 30 minutes plus.
Yeah, rake them over the coals.
Yes.
All right.
All right. Thanks, guys.
All right. Have a good one,
Thank you, Blake.
Thanks. Have a great day.
Okay,
hey,
so
you guys have two families as well? One that you make money with and one that you spend money with?
If you count Steve's illegitimate children, you probably have 12.
Which of all? I have so many.
Yeah, that's what I said.
All those interrupters all over Greece. So, God.
Right. One more thing I wanted to mention, and that's obviously we had the U.S.-China Phase 1 deal signed and everything. Hooray for that. Now we're President Trump today said that Phase 2 negotiations are going to start imminently, but I think it was...
The Chinese are not saying the same, by the way. They haven't been saying the same.
And Mnuchin, I think, did say today that doesn't necessarily mean that all tariffs are going to be rolled back in Phase 2. So you know, we've made a kind of.
I'll make a prediction. None of them is going to be. Another bad Canadian data. Canadian manufacturing, we just got it minus 0.6.
Wow.
Versus minus 0.2 expected. We did have though a revision higher in the previous monthly reading to
Yes,
minus
so that's
0.2 from
more bad
minus
data than
0.7. So you know they cancel each other out. I mean, we had more or less the same miss this month, and we had a revision higher for last month. So it's more or less unchanged. So Stelio, I think we're not going to get any tariff going away in phase 2, because I don't believe we're going to see phase 2.
Well, if you're offering at 0, I'll lift you at 0. But
yeah, no, I'm not offering at 0 because there's no upside. But you know, I really strongly believe that the chances of seeing a phase 2 deal are very, very low.
Yeah. I have a question for you, Steve, actually. I mean, I don't have much else to say today. I have a question for you. Why are metals selling off when we have a little bit of risk off? Do you get that? And the dollar is selling off as well. I don't get it.
Yes, depends on the metal to begin with.
Oh, gold and silver.
Gold, for example, is holding up better on the day. And, you know, we've seen lately quite frequently metals going against the direction of the dollar, right? So, for example, a big part of the move higher we've seen in the dollar was happening as the DXY was holding up very nicely. So that's that's one element that it's not that, I mean, yes, they're dollar denominated, but they're not moving in absolute correlation with the dollar. Now if we have a look at the yields, because we know that one of the elements that wrong place to open the chart. Give me a second. So here is gold, and here are the yields. So if we look at the yields are actually lower today. So theoretically speaking, that should also be helping the metal. So it can't be explained by risk on, risk off, and it can't be explained by opportunity cost. So who knows, right?
Yeah, it's just a little bit weird. I know the correlation hasn't stood. Sometimes.
Yeah, not that strongly. Yes.
It doesn't make too much sense. But anyway, yeah.
Yeah, I mean, if we overlay, let's take DXY. So here's DXY, and let's add here gold. Look at this. We've had periods actually that the correlation was inverse. Look at this.
Yep.
Right? Look at this period, for example, or look at this period, period. So we've had periods which is counterintuitive. The last one here as well. The DXY was, sorry, my mistake. I need to remove that because what I want to do here is add this. Okay, so here it is. So here it is, the inverse actually. So we've had periods that it's actually not, not moving along with the inverse, which it should be, right? So you see, we have had this big decoupling back here. So the DXY kept moving higher while gold was moving higher as well. Now I've put the inverse of gold here, so we can see the relationship better. So you can see this big decoupling that we've had. So yeah, I mean, we've had this period of time that it hasn't been working like that. Stelio, did we have anything else besides the UK data today and the Canadian data that we just got?
No, my friend, no. That's pretty much it. We're waiting to see what happens with the World Economic Forum, if anything of use.
Yeah, with Davos. Yeah. But speaking of which, and since we're showing DXY, we kept saying the previous days, Friday and Monday, that the DXY was actually testing very key resistance, and so far we're seeing a nice attempt to get rejected from there. The exact same thing happened, the exact opposite thing to be literate, happened for the euro. Euro was testing this support area, which was key because a break below that would also trigger this head and shoulders formation. We got a very nice rebound from this confluence of supports. I was also mentioning Aussie yesterday for those that were here because it was a US holiday, saying that the same thing was happening with the Aussie. Aussie tested 2 consecutive days so far, this confluence of supports, also head and shoulders formation, neckline. So far, we seem to be holding. So as it seems, and as I was warning, getting very bullish, the dollar right on resistance made no sense because it was a dangerous proposition. I mean, the risk reward would favor a move lower from there. And so far, we're seeing that. Of course, that doesn't mean that we can't, pull back a little bit and then punch through 97.70. But until we do that, you need to respect the fact that we have been correcting lower since the 1st of October. So, we are in the middle of January. Actually, we're getting closer to the end of January, and so we are more than 3.5 months in this descending formation, and it is what it is. So we might see more weakness, another move towards 96.30, even lower than that, because this trend line support is moving lower by the day. So at the same time, I was saying yesterday, for those that weren't here, that the cable was getting to a point that it has to make a decision, because this triangle that we were monitoring had in essence run out of space. The 2 lines had converged too much with each other, so it had to make a move one direction or the other. So far, it seems to be holding that horizontal support area. And if I see a higher high here, which would in essence mean anything above 131.20, I think that's going to be a nice indication that the cable has started another leg to the upside, perhaps towards 136. So, so far, if you wanted to be bearish the dollar, you're being compensated for that. Of course, you need to take everything with a pinch of salt, because as I've said, the move lower in the dollar is definitely so far not impulsive in nature, right? So, I mean, we haven't seen a clear-cut move one direction or the other. But as I said, below 97.70, I think that the risk reward favors being short the dollar as we speak. Now, I've put a lot of focus also lately on platinum, looking for a reversal lower. And so far, I do like what I'm seeing here, because today we tested for a 3rd consecutive day the same 261.8% extension above 2,500. We seem to be getting rejected once again, and we're actually threatening with an outside key reversal after a huge move higher. Yesterday, the daily RSI was above 92 when we were conducting the webinar. I'm still short 2/3 of a position. I'm slightly in the money now, and I'm looking to add if we actually close below yesterday's low of the day. And as I was saying, I do think that such a parabolic move higher cannot be resolved by a horizontal consolidation. I think if today's move proves to be lasting for the duration of the day, I think that we're going to be looking into the beginning of a very, very sharp correction lower. I would expect that we can easily, by the first days of February, come back to 2000. I know that it seems to be far away as we speak, but I do believe that such a parabolic market can actually plunge $500 in a matter of a couple of weeks. So I'm still looking forward to this playing out. Now, yesterday we were given a question from a webinar viewer. We were looking at copper, saying that copper was at a nice juncture to also push lower. Now, of course, palladium and copper, because Stelios mentioned that before, palladium and copper makes sense for them to be lower on a day that smells a little bit of like risk off, right? And I'm saying a little bit because it's not that we've seen like a big breakdown in in risk or anything, but we've seen a couple of headlines come through the markets which could cause a bigger decline, especially given the fact that we've been extremely overbought in really no news. I mean, everything that has happened during the past 1 to 2 months had already been priced in by the markets, and that's why I mention it as no news, because the market is a discount mechanism. So something that's already priced in isn't supposed to be affecting price. So I don't consider, for example, the signing of this extremely light version of a phase 1 deal being market moving event, as it wasn't, because in essence the day that we actually signed the deal, the market did almost nothing. I mean, it was already, everything was priced in. So I would expect copper and palladium to sell off during risk off. But as Stelios mentioned, monetary metals like gold and silver, gold mostly, because silver is a hybrid. It's like both a monetary metal and an industrial metal, while gold is mostly, let's say, a monetary metal. So I'm really looking forward to seeing what's going to happen here, especially with silver, because as I was saying, there are a lot of interpretations in the price action here in silver. And as I was saying last week, at the end of last week, you can't know exactly what kind of information you get. I mean, perhaps that could have been a pennant, but unless you see more price action, you don't know exactly what is the nature of this correction lower. So I have to say that today's move lower seems to be quite strong, especially given the fact that dollar is under pressure. So especially if we bridge through 1770, I would assume that silver is going to be gunning for the next downside support area, which is at 1725. Now gold seems to be holding better here, but that doesn't mean that it can't also move lower, because for example, the corrective formation might be something like this. So we might have found resistance, and we might need to correct or consolidate more before we can actually push higher. So I still remain skeptical. As I was saying, I would have even more confidence if we saw a higher high. So that would be a daily close above like 1562, 1563, having to do with gold, and a daily close above 1810, 1820 in silver. So we didn't get any of that. And I think that more or less covers metals. One more, platinum, actually. So platinum, I also mentioned yesterday that platinum was testing a very key support resistance area. You can see the dates back to 2015. So it has acted multiple times as support resistance. And, after attempting like for 5 consecutive days, including today, to push above this 1025 level and actually close above it, we failed. And today might prove to be quite a big decisive rejection from that level. So of course, that doesn't change the fact that we've gone above a very key trend line resistance. So I would still be looking for higher prices, but that might happen from lower levels. Okay, Rsi Divergence was also telling here, as you see. I mean, back in September, that high, we had, Rsi being above 85, and, the latest reading in the Rsi was barely above 70. So, it's obviously, quite a big difference. Now, let me open the question box and see what you want to. Good one, Dale. Of note, SPY had 12% correction in November with the SAR breakout. Yeah, that's a good point, actually. Mnuchin's second phase 2 trade deal may not remove all tariffs. Yes, we mentioned that. Thank you. No comparison, I think, 2002 with now. Yes, having to do with, the part of the cycle we were in. Indeed, there's no comparison. I would agree with that.
The exact opposite.
Yes,
Because we bottomed in March of 2002.
Exactly.
And
So
here we are, 18
11
years later.
11 years in this business cycle, right?
Oh, yeah.
Yeah. And back then, we were just like,
It was after
out of,
the dot-com bust. It took a few years for the low to come in.
yeah, we were just out of the fake recession, as I call it, the 2001 one. And I'm saying that because probably it's the first recession in the history that debt didn't move lower, because everybody was focused. I mean, politicians and the Fed were focused in essence in kickstarting the economy immediately. And back then there was still significant firepower in monetary policy because it hadn't been exhausted in the extent it has been today. So in essence, they kickstarted the economy with monetary policy, immediately. So in essence, that was like a short recession that didn't have any of the rebalancing you expect to see in such a case.
In fact, it was a shift, because I remember I was living on the ocean in Lucadia, and a few years prior, Clinton had changed the tax laws about capital gains on real estate, home that you live in. So the dot-com bubble, once it burst, everything moved into real estate to set up the next crisis.
But that was the only way they could have escaped that immediately, to immediately inflate the next bubble, which is exactly what they did.
Yeah.
Because in essence, the dot-com bubble, everybody's like blaming, the bankers, the greedy bankers, etc. But the business of the bankers is to be greedy. The question is, okay, the bankers are greedy, but what did the politicians, what did the Federal Reserve and the rest of the central banks that supposedly are the ones that are monitoring and creating the environment under which the bankers and every other enterprise or business is working within, what did they do about it? The answer is they did everything they could to incentivize people to participate in that bubble, and not the opposite. So it's not that the issue escaped their attention and they just didn't realize and they let it happen. It's that they made it possible. Freddie Mac, Fannie Mae, and all that, and all the incentives as the one you mentioned, Dale, that they gave was exactly about that, to build the next bubble, which was with home prices and and homes. And they succeeded in that, but the results, we already know the results of that. We saw them in 2007, 2008, 2009. And then they wanted to build the next bubble, and now we're more or less.
And they got so good at it, now they've inflated many bubbles all at the same time.
Oh yeah,
it went from .com to real estate to everything.
Now it's the everything bubble in essence, yes.
Yeah.
Because the point is that once you depress yields by so much, I mean so extremely much, because it's not a nominal. It's not the nominal yield that matters. It's not even the real yield that matters. It's the comparison of what you get as a real yield versus the actual risk that you take. So, for example, I mean, just by comparing the previous business cycles maximum interest rates, which were like what, 5%, with today's, makes no sense, because when you compare, for example, the US treasuries of the US as it was back then, with the debt and deficits it had then, with today's US treasuries, with the deficit having exploded and the debt increasing in an exponential pace, and then you realize that, you had much higher yields with the sovereign risk being far, far lower than it is today, you realize that actually it's not even a fair comparison to say, oh, last business cycle, we made it to 5% interest rates in the 10-year. Now we made it to 2.5%. Yeah, but as I said, it's not ceteris paribus. You're not comparing apples with apples in this case, because you're not taking into account the rest of the factors that, affect or are supposed to affect in a healthy market environment the risk, the yield I wanted to say, but I was thinking of risk because in essence the yield in a big extent is a risk premium, right? And that risk premium they've completely eliminated out of the market. So the market is forbidden from pricing any risk anymore. And that is extremely, extremely dangerous and unhealthy. I mean, it can only end one way. Now, betting exactly when it's going to end, is not easy business, right?
Yep.
But betting what the end is going to be, it's extremely easy business. You don't need to be, a guru or a medium or whatever.
Yeah, just read Ludwig van Mises.
Yeah, Mises, yes.
Right?
Yes.
Miser.
No, Mises. You said it right.
I know, I was kidding.
Yeah, that's how you write.
Misers.
There it
There
is.
he is.
You see?
There's Ludwig.
Yeah.
It's what I look like now.
I want to see your mustache.
Anyway.
Actually, as we're speaking, the metals are getting, even more under. Palladium is currently like 3% lower on the day, and especially if you take into account the high of the day, which was at 25.30. Just to give you an idea of what I said before, today's high and low of the day so far have a distance of $120. Just for you to understand what I said, that I really believe that within a couple of weeks we can be back to 2000. I mean, already today, within half a day, we've covered $120. So, having to do with indices, there is nothing to cheer about yet, having to do with, seeing some downside. So we've gone from one formation to the next and to the next and to the next, as you see here on the 4-hour chart. Now, this pullback is still minuscule. I mean, we haven't really violated any real support area. So can this be the beginning of like a decent correction lower? Yes, it can. But, do we have technical evidence yet that that's the case? No, if somebody says that, it's irresponsible. So no, that's not the case. I mean, we would need to see at least a breakdown from 32.85, I would say. And even more important, I think, is the 32.60, 32.62 area. I think that only a break below that will indicate that we're actually at the beginning of, a deeper correction lower, actually, because we haven't seen any type of a correction since the very first days of October. I mean, whatever pullback we've seen since the beginning of October was like minuscule and very, very short-lived. I mean, keep in mind, this is a 4-hour chart. And as you see, like the biggest correction lower we've had was, what was it? Like 2.7% in a run that has actually taken us almost 17% higher. Yeah, 16 point something percent higher. So, it has been, since the very first days of October, it has been a one-way train, a one-way street going higher. That can't last for much longer. Now, another pair that actually found resistance in this case today at quite an interesting area is the USD Swiss. USD Swiss got rejected, is getting rejected so far from this descending channel. So, this is another one worth paying attention to. I am, acknowledging the fact that we're seeing some Rsi divergence here, and momentum has clearly stalled at a quite important support area. But, as long as this resistance is holding, there is a chance that we're going to see more weakness following that. USD yen is breaking out. I don't see your view getting correct. Let me see. Is there something happening with USD yen now, or you mean in general? Yeah, so far it hasn't broken out, as you see. This is the trend line we're looking for. There it is. You see it? So far, still finding resistance perfectly from that trend line. So hasn't yet broken out. So it's, as I was saying the other day, this is a pivot area for USD yen, right? So, we break higher from there. That's quite an important event, but we get rejected from here, it's also important technical event. So you have to remain a little bit patient and see what happens from this area. But keep in mind that from a risk reward perspective, exactly as we were saying yesterday about the DXY, the Euro USD, etc., from a risk reward perspective, if you have to be short or long right now, right here, in my opinion, it's a no-brainer. I mean, I would be short here because I can risk very, very little to potentially see a decent move lower if we get some risk off, or if we see yields sliding or whatever, right? So from a risk reward perspective, I wouldn't be buying this move from 107.60 up to 110.30 exactly at multi-year resistance. USD SEC, Blake mentioned it before, but he didn't show a chart. That's what I'm looking for here in USD SEC. I'm viewing this rebound so far as corrective, so I think that this has also a decent chance of rolling over from here. And more or less the same deal with USD NOK. USD NOK, that move lower was clearly an impulsive leg lower, and so far I'm viewing this rebound higher as corrective. So I'm monitoring this ascending channel and looking to see how it's going to play out. I don't want to see it higher from here. If I do, I'm going to take profits on the last half of my position and call it a fine trade, but I'm really still holding to it because I think there is a very good chance that it's going to roll over and produce at least one more low before we can see a bigger rebound higher. Coronavirus has spread to Thailand and Japan. The SARS-like outbreak is believed to have originated in the central Chinese city of Wuhan, where 198 cases have been recorded. The country has confirmed a total 217 cases of the mysterious illness, with 5 patients in the capital city Beijing and 14 in Guangdong. State broadcaster CCTV reported. Okay, thank you, Scott. Officials said the epidemic has spread to okay. Euro Kiwi, Kiwi and Aussie CAD. Sure, let's have a look at them. Let's have a look at Euro Aussie, Euro Kiwi, since you asked for it. Let's go. So Euro Aussie, nothing has really changed since the last time we had a look at it. Still remains in the middle of this range. You can see it here with green. It's a rectangle. So we've been trapped in this rectangle since August. So it's getting close to 6 months that we've been in this rather tight range. So I think that, until we break out from either support or resistance, you should actually be doing nothing with it. Now, having to do with the Euro Kiwi looks more clear in my eyes from a technical perspective because we had this symmetrical triangle here. We broke down below it. We came up. We retested the broken trend line support as resistance. So against this high at, let's call it 169.25, let's say, it looks like a decent short. So if I wanted necessarily to have a position in either Euro Aussie or Euro Kiwi, I would choose Euro Kiwi to be short. That's my point of view here. Okay. Now, your question about the Kiwi and Aussie CAD, let's have a look at both of them. So we already saw the Aussie USD rebounding from a potential neckline. So far, as long as it's holding that confluence of support at 68.50, I mean, somebody can still have a bullish bias, and from a technical perspective, it makes sense. And, Kiwi looks even better if you're looking to be bullish because we broke out from this descending trend line resistance, and so far the move lower has corrective characteristics. I mean, it's quite orderly, right? So as long as we stay above this broken trend line resistance, which if we get down to it might act as support, I think from a risk reward perspective, it makes sense looking for higher prices. Another trend line you might want to pay attention to, and you can be bullish against, is this ascending trend line support. Okay, so I think those are the 2 trend lines you should be watching to, to determine if you want to be long or short the Kiwi. Now, having to do with the Aussie CAD that you asked. Now, Aussie CAD, quite complicated. Initially, I was looking potentially for an inverted head and shoulders formation, but once that failed, I had to reassess and look at this as a correction higher. And by redrawing this like that, it looks quite interesting because we broke down from this pennant, we retested its trend line support as a resistance, and so far we've stayed below it. So price action is quite choppy. So if I want to be honest, I wouldn't have a position here, but if I was forced to have a position, I think that against 90.50, it makes sense to be short. But as I said, my first reaction here would be, choose something that's, more clear on the chart. And here is also the Kiwi CAD. Kiwi CAD has the potential of forming a head and shoulders formation. In order for me to confirm that, I would want to see a move definitely below 86 cents, perhaps 85, 80 or something like that. Okay, so there is potential for more downside here as well, but it doesn't look eager to really move fast in any direction. So I have to, I have to note that. Now, another one worth mentioning, if we're, since we're on the subject of talking about the Aussie.
All right. Well, we're at interview time now, Steve.
Oh,
so
sorry,
wrap it.
Coach.
That's okay.
Yeah. So Aussie yen also looks like this rebound higher might be corrective. I think that, a failure from this trend line support a little bit lower, we also have the 15-200 DMAs, would probably indicate there is more downside coming, and it might actually indicate that, this rebound higher has run its course, and we're looking at a move to new lows. So that's it. Thank you. So we
Nice
have Mark
review.
today. We have
Yes.
Mark today, right? Okay,
Yep.
cool. Let's see what he has to say.
Okay. Hi,
Enjoy.
Mark. Welcome back.
Hi, Dale. Can you hear me?
Yeah, I can hear you, Mark. Loud and clear. How are you?
Wonderful. Thank you very much. I'm great. Nice to be back.
Yeah, Happy New Year to you. And you could share your screen after Steve stops his share. There you go. And I'm not sure if you've been here in Zoom with us, but it's a green box that says share.
Let's see.
It's a drop-down menu. Green box will say share, and you click it, and then you choose the screen. See it?
No, I don't see any box. I'm looking at just a Zoom meeting screen. It shows my name in the middle. I'm looking, let's see.
Might be at the top or at the bottom of your screen, Mark. You might need to mouse over it to get like a pop-up bar, which has all the buttons, like the mute button, the start video, Q&A, share.
Let's see. Enter full screen. No. Q&A, raise hand, chat, mute.
Has to have a share button as well, exactly along
Next
the
to
rest
the
of the
Q&A.
Q&A. Okay.
Next to Q&A, there should be a green share box. Nope.
Okay, still looking. Yeah, I just see chat, raise hand, and Q&A. So right now I don't see that.
All right, let me see.
Is there a different? Am I on a different version?
Wait a second, Coach. You haven't actually. You haven't. I think you made the panelist the wrong person. So you haven't actually. Yeah, there.
No.
There we go.
Yeah, now you go. Okay.
Did I?
Yeah.
Mark, there's only one Mark Newton.
Can you see it now, Mark?
That's
because
perfect.
He's got it. Beautiful,
because,
Mark.
Yeah, because he wasn't a panelist
Okay.
until now. Yeah.
I think you had to make me the panelist, and that's why I didn't show up initially, but that's fine. No worries.
I'm very low tech, Mark. How are you?
I'm fine. How you doing? Happy New Year. Good to see you.
Yeah, nice to hear from you, buddy. And, like I said on Twitter, I want to acknowledge, when some people were nervous about the markets being elevated last time we talked, all your work was saying higher. I think back then you were looking for recovering yields and favored the banking sector because we'd have some steepening in the curve, and that worked out. And So I'm pretty curious. You said you didn't see any trouble really for markets until the spring, and here we are a couple months away from the spring equinox. So go ahead, take it away, buddy.
The market's been incredibly resilient, as we all know, with regards to equities.
Yeah.
You know, price action has not really shown us any indication of any weakness whatsoever. When I came into the year, there was a couple cycles that indicated a potential for turning in January. Those really have passed as of now. I think that we're in really the final week where that can work. And if we get past that, then potentially we could extend out until right around the 17th of February into the 24th, and that would be also important. But you know, my concerns at this point have to do with momentum just being overbought on really a daily and a weekly and really a monthly basis, and really showing a lot of signs of flattening out. I think that's important. So initially, you look at things like the S&P, you see that we've rallied, you know, a good 15% just since October, but yet things like RSI cannot even hit the levels that we saw back in the latter part of December. And so historically, when you start to see indices press higher, but momentum can't really reach those former peaks, oftentimes that can be problematic, like we saw last September. And if you look at the left-hand side of the screen, you see that we pressed higher, RSI is lower. You also saw that in July, and now we're really seeing it again. So that's a little bit of a concern. And on a weekly basis, we're obviously seeing RSI levels now at 79, the highest level in almost 2 years, and we're up through the higher part of Bollinger. Monthly basis is really what causes me a little bit of concern, and that, you know, RSI is at a 71, but we're nowhere near the peaks that we saw back in January 2018. And so, you know, there's been a definite flattening out of momentum. A lot of times that does happen when you see a little bit of a divergence. And of course, we would need to stall out and turn down for that to be problematic. For now,
Would it have to be something like Apple, Mark? I mean, you know, Apple has a larger market cap than the Australian, all of the Australian market. And then I told that to Steve, and he said it even has a larger market cap than the total amount of market cap in DAX.
Yeah, pretty incredible. I mean, Apple was a stock I highlighted last week and suggested that really the stock is at a level where it should be sold. And I firmly believe that. Technically, I no longer own the stock. It's been a nice run. It's just gotten a little bit too parabolic for my taste. And, you know, we're seeing it on, you know, multiple time frames now where you look at the stock and, you know, on a weekly basis, you can see the RSI is up at an 89. It's really the highest it's been in a long, long time. And so it's going to be very, very difficult for the stock to really replicate, you know, its performance from last year as we head into 2020. It's only been a handful of occasions where we've seen momentum this high, even on a monthly basis over the last 20 years. And so each of those times, typically you see the stock start to flatten out. And so given that we have 5 stocks now in the S&P, you know, that are you know, approaching the $1 trillion club that now represent about close to 18% of the index, I mean, I view that as problematic.
Yeah.
But initially, I had a list of 5 concerns. I said, you know what, momentum is overbought now. It's diverging negatively. Sentiment has now gotten frothy. DeMark signals are showing exhaustion, at least on a daily time frame. The weekly is still a couple of weeks away. Cycles tend to turn down at this point in January. If you overlay the 10, 20, 30, 40, 50 years on top of this, historically the market tends to turn in the middle part of January. So I am on the lookout from that. And financial underperformance is something that we've started to see a little bit more dramatically of late, and I think that's also a problem.
The banks got hit, a lot of it on earnings, but could it also be, Mark, that you know, I look at the 10-year yield chart, and it looks like we're on the verge of a breakdown, like under 173 or 170 is going to be kind of a negative signal that could lead to a retest of the 143 level. And I've actually noticed the last week or so that the 30-year, that the steepening that was occurring is starting to dissipate again.
Yes. Yeah, I think that's important. I think that the whole structure of this move since August has been rather, choppy and corrective. It's not really all that convincing that yields have made a really meaningful low, in my view. So, today's move is interesting. Yields have pulled back pretty sharply from December, and stocks obviously have not really followed suit. We've been going higher as yields have been moving lower. So, it's been interesting in the last month that stocks and bonds have rallied in unison, and that can happen, of course. But, my view is that, the move in the financials is interesting. The equal weighted financials index has actually been going down since the middle part of 2018. And so the XLF being up near all-time highs, it's really just been, Bank of America, JP Morgan, Citigroup, a lot of those have been, showing that kind of strength. But the majority of the index actually is moving exactly the opposite. We've actually been, we've seen a pretty pronounced breakdown in, when you look at equal weighted financials versus the S&P or just the financial indices. So a lot of it's just been a lot of the large cap financial group. But the XLF, the one thing that makes me a little bit wary about being too bearish just yet is when you look at things like, financials on a monthly basis now breaking out above all-time highs. You see a pretty historic breakout also in the industrials sector. So this is just a monthly chart of XLF, and it's fascinating that we're in the process of exceeding these former highs that were made back in 2007, first time in 13 years. XLI and healthcare.
Sure took a long time compared to other sectors.
Yeah, I mean, XLI is now breaking out. It's gotten extended, but on a short-term basis, that's still pretty constructive when you see, the move in XLI, for example. So I'm sort of grappling with what could happen that could lead this down. If industrials for the first time are breaking out above 2018 highs out of this nice base, financials are also doing the same. Healthcare recently has done the same. It's going to fall on technology to really, if tech starts to fall, these are other sectors that look like they're starting to step in.
They'll rotate into these.
But overall, I've been bullish for the last few years. My annual technical outlook, which I'd invite people to visit my website, and they're available to clients. It actually turned bearish this year for the first time in quite some time. I do think that this year has an above average chance of being a down year. And so I think that's going to continue through 2022, and that we could have our first bear market in a while. And, we don't really see any evidence of that right now, but so it's going to take at least some first shot across the bow to take indices lower, and then probably the retest on much lower breadth and volume. But
so maybe 6 to 10% from maybe last week's highs or the highs that we're about to put in, and then the recovery will have a lot of market messages in it, won't it? If that happens.
It will. I think that if we have any sort of pullback in February, that could be the first sign of really testing these trends. It just doesn't have a lot of appeal for me to chase markets at these levels, given that you're seeing things like the put to call. And this is an interesting ratio that you've really moved down to the lowest levels you've seen in over 5 years on a monthly chart. 13-week moving average of that has really gone substantially lower, and now is at the lowest level on the 13-week that we've seen in almost 10 years. So a pretty radical departure from what we'd seen of late. And you definitely started to see some evidence of risk on type positioning towards the latter part of the year, last year.
Yeah.
And people got to be a lot more comfortable with the Fed, and they felt like the trade deal was on, and there's just everything had been moved to the back burner, which had been a concern last year. And you saw that
they solved everything. They solved everything, but I would like to know what your take is on what's been happening in the overnight market and repo market. And I know you're a great technician, but I know you also look at things under the hood, the fundamentals of the engine. Are we throwing a rod
Well, that's a larger question.
Yeah.
I wish we don't have enough time to
Okay.
discuss that in detail. I
How
wish,
about the cliff notes?
yeah, I would say the one thing that's interesting that's different in the last couple of weeks is that you're seeing high yields start to lag a bit, and that's something.
Okay.
This is just a ratio of the spread between the LQD and the HYG, and for the first time you're seeing this really break out a little bit, which indicates a widening of credit, and the high yield has not really followed suit. The other is that you started to see real evidence of defensive positioning also. We haven't seen that in some time. Last week, utilities actually outperformed technology by a wide margin. So
Yeah.
you're seeing a
at that.
push back into these defensive groups. This is the utility sector. You've seen it in the REITs as well, where you see the REIT outperformance. So those are a few
And
things.
TLT, Mark, TLT is in a big symmetrical
Yeah.
triangle that's compressing. And it looks, I mean, the bias for me is that it's going to come out to the upside. Okay, you have a different triangle, but we're right there. This compression is unbelievable. What do you think here?
Yeah, my thinking is you probably do break out to the upside just because
Yeah.
I'm more bullish on treasuries here. I think that it's tough to make much of this little choppy move as being anything all that all that negative in thinking a top is in. So I'm expecting that
Yeah, there you go.
if you
Yeah.
take out 140 on this,
Yeah.
then that should be a pretty much a straight shot to getting back towards highs. So I share your optimism on the treasury market, I think, and thinking that the long end, interestingly enough, you did see some indication of the 2s 10s starting to break down, finally after a pretty big steepening since last August, and
Yeah.
now that's really challenging, pretty key levels. The one thing that's interesting to me though is when you look at a monthly basis, you've seen a pretty decent breakout in that also that historically had happened, at prior stock market peaks back in 2000 and also in 07 when you started to see we've had some pretty good DeMark buy signals on this and a pretty decent. I would view this to at least be some sort of a breakout on a monthly basis of this downside in
I've seen
yield
that.
curve. However, you could easily give this back over the next few months and
And not make new lows. How about yields make new lows, but the 210s don't? 10-year makes a new low. Huh?
I view this as being a little bit more intermediate term.
Okay.
Bullish if you want to buy, but near term, you are seeing that evidence of a little bit of a flattening.
You were very constructive on precious metals and the miners last time too. In fact, I think almost everything you talked about manifested. What a run we had in the miners and precious metals, and your look now.
Well, I think it's interesting what's happening in gold. A lot of people were of the opinion that we could have potentially a peak in gold in the month of January. I think the positioning is still pretty optimistic. A lot of that's going to depend on really what happens with the dollar and, of course, with yields. If yields stay low, then it might be tough for gold to have too much of a setback. But the move today is pretty interesting and pretty negative, I think, both in what we're seeing in crude oil and also in the precious metals. We've seen that already in the base metals, and what's happening with arguably a lot of the stocks that have to do with aluminum and steel. I mean, those have been very compressed for some time, and the GDX has really stood out as being a lot more constructive. But when you look at charts like the XME, I mean, that's showing a real breakdown. So a lot of that is aluminum and steel stocks, and those have been compressed. Coal stocks, those are really not where you want to be. The GDX, however, has been, arguably a lot better. So, we'll see. I think that if gold really starts to wash out a little bit, I mean, as long as the GDX remains above 2768, then, you'd still be constructive on that and thinking it can work. Under that really changes things pretty dramatically. I've been pretty constructive still on the metal space, and today is a little bit of a wake-up call, I think, where you have to pay attention. Anything under 1536, and it would argue you could take the shape of whatever it might be, maybe an ABC type corrective move to the downside. The dollar has been strengthening.
I'm glad
lately.
you're going there because that's so unclear. And, people keep bringing up, well, who cares about the dollar? It's in the same place it was 2 years ago, which is true. We really haven't gone anywhere. And I thought we may have had a turn to the downside
Yeah.
with what happened a few months ago. Is that in question or what? What do you think?
I don't think yet. I think you can still make that case that the breakdown that we saw is more important than the little snapback rally.
Okay.
I think that, I look at the Bloomberg Dollar Index just because it has a lesser percentage against the euro, and so that's still more of a corrective type phase. You could get up to 1,200 without this doing much damage, and then turn back to the downside. Yeah, it has been sideways. What's interesting is you're seeing the dollar make a lot of interesting movement against some of the the LATAM currencies. Though when you take a look at against the Colombian peso, against the Brazilian real, I mean those are very interesting longer term charts for people that look at things technically when you look at these. And so it's interesting to see how this is going to manifest itself if the dollar. If we see weakness in the real beyond 430, that would be very substantial to this weekly chart on dollar real, in my view.
Yeah, so these countries need a weaker dollar.
But in general, I think that the charts of like the euro and everything else,
constructive.
Yeah, I still, right now it's tough to be.
Anything.
I've seen some progress, and of course that we've seen that shift a bit in the last couple weeks, and so we're really at sort of a do or die here in the short run. I mean, you can't afford to really take out multiple weeks of lows without thinking we're going to reach, which would be a little bit of a bigger bounce for the dollar. But if that happens, then we'll lose some of the EM strength.
Right. Because a lot of people are gravitating towards that because they think the dollar has peaked. They're going to foreign markets to take advantage of a weaker dollar. You're not in that camp?
I had been. I think now you've seen the dollar bounce. This is what's interesting to me is you look at things like Mexico, which has recently made a pretty decent breakout last week of this trend that's been intact since 2017. And of course, you've seen it also in the EEM making a very substantial move. But these moves largely have already transpired. So I think we're within a couple weeks of this starting to slow now. I mean, it was right to be bullish on emerging markets back in, last October when these moves started. Now, within a couple weeks, you might see a slowdown in that, and maybe that does coincide with the dollar, bouncing a bit. The dollar is at a pretty pivotal point, so it's tough to have a lot of conviction.
Yeah,
like
that's what. Before. Yeah, I don't have trouble saying I don't know.
Yeah, I think that we've had a big move in these, and now the DXY obviously showing some little bit of a reversal today.
Yeah,
obviously a key level. So for now you can remain bearish. I think that anything above last week's highs, and that would change pretty dramatically, particularly if you get above late December, and that would make you think we're going to push up. So
okay,
that would. The commodity indexes, indices largely have been still pretty positive and pretty bullish. I mean, this move is just, largely consolidation. I think that you can get a little bit of near-term weakness over the next couple of days.
A lot of people liking agricultural commodities here, Mark. Big bases in beans and wheat and sugar and, reminds me of the 70s, if I could remember that far back. But, what I'd like.
Had a big move, but I think, some of these have, we'll see what happens with, some of these have taken a turn back to the downside lately. We'll see. That was soybeans. I mean, corn is, a lot of these are basing, but
long-term basis. I'd like to wrap it with a key statement you made is on your yearly outlook. This is one of the first years in a long time where you thought there could be a negative outcome. And we've gone over all the near-term charts. So can you give me the highlights of what makes you think that way?
it really boils down to really 4 or 5 important things, and one is that momentum, in my view, still is really flattening out on a longer term basis, and so that is very important. The second is that sentiment is starting to get a lot more frothy into the beginning of this year, at least. Sentiment is a concern. The cycles that I look at, particularly the 20-year cycle, is going to come due, and historically, there's just a lot of energy toward, particularly as we go through April, May, and then towards the latter part of this year, they're going to be very important, I think, heading into 2021. And so, that's interesting to me. And, we need to see some evidence of the markets really breaking, though, and we haven't seen that. So
Right.
It's always tough to look at. I'm not a long-term forecaster. I tend to concentrate more on the here and now and really what's happening than making these big projections. And so, subscribers know that I look out 4 to 6 weeks. I don't look out a year or two. But, I do think that the longer-term cycles do suggest that the market should be starting to top out this year. We've seen that with momentum. We just haven't seen it in price. And so, let's for now, it's still right to be constructive, but I would argue that implied volatility is starting to firm and has been in recent months, and that argues at the very least to buy vol here going out the next couple months, and that that's the right thing to do now is to look to buy long dated, buy implied volatility, use that to really hedge your long positions, and when we start to break down, then that'll give a little bit better evidence of being a time to short.
Yeah, great look at the VIX. Hasn't made new lows in such a long time, Mark, with market making successive new highs. That's a great look into something not confirming this euphoria.
Yeah, the combination now of the put to call turning down as dramatically as it has while the VIX is holding up. And, for the first time all year since December, actually, you have, the S&P and many of the major indices are just now in the last couple days showing DeMark sells. Within 2 days' time, this will be complete on a setup after this whole run up since December. So this is an important time. I'm certainly not going to press longs here. I'd be more apt to take things off, particularly in these tech stocks that have done well. You're seeing the defensive positioning. You're seeing yields start to turn down. These things should be important. For those, many people look at long-term trends and they say it's not a worry. And, I can't disagree with that if you manage money on that basis. But for those that look at tactical short-term type positioning, there are a few warning signs now, and so I think it's right to heed that.
I like your philosophy, Mark. Do the right thing today, and tomorrow takes care of itself.
Yes, sir.
So why don't we go to your website so people know how they could get your year ahead report and subscribe. You're putting out some work for retail. I know you handle a lot of institutions, but you're also writing some content for the retail trader.
I don't try to I really make it available to anybody who likes it. I do personalize work to institutions, but my work, I put out work every weekday that's available to the individuals or institutions. That really covers 2 or 3 major charts, some of the sector rotation. I give some longs and shorts. I have a promo video in here that I'd invite people to take a look at that, really discusses how I go about my thought process and really discusses the business in detail. So NewtonAdvisor.com is a website. I'm happy to extend a free trial for a couple weeks, or you can send me an email to info@NewtonAdvisor.com.
Nice offer, Mark. So, I hope this is a great year for you, my trading warrior brother, and that you're in the green and all the turns you're on top of, and really appreciate you and
Thanks,
what you bring to the table every time I talk to you.
No, it's great to join you guys, and I'm happy to discuss anything further offline. You feel free to shoot me an email, and we can continue the discussion. So have a great, rest of the week and a good rest of the year for all those that are listening.
Thank you, Mark. We'll get back together soon. Everyone, that's Mark Newton, and you could get his, he's offering a free trial at www.newtonadvisor.com, and you could follow him on Twitter at Mark Newton. I believe it's, what is it?
Mark Newton CMT. Yeah,
That's
and I have a
right.
private Twitter for clients that discusses long and shorts every day at Newton Advisors,
Wow.
but that's only for clients. But I run that every day, as well as some work on stock twits for those that just want longs and shorts. So I come up with 3 to 5. I run sort of a mini portfolio on stock twits, and I'm just putting out long and shorts every day on my website. So I'm happy to discuss that with those that are interested.
Okay, don't forget to sleep. Mark is one of the hardest working technicians I know. All right, so everyone, that's a wrap for Turnaround Tuesday. Thank you, Mark Newton. And remember, don't just count your pips, count your blessings. We'll see everyone tomorrow. Adios.
Thanks, Dale.
Thank you, Mark.